All right. Good morning, everyone, and welcome. Thank you for taking the time to join us today for San Francisco Financial Counseling's webinar, Teens and Money. This is in partnership with the San Francisco Public Library, one of our wonderful, trusted partners. And yeah, just to give you a little bit of background, San Francisco Financial Counseling is one of the flagship programs of the Office of Financial Empowerment, which is a unit under the umbrella of the Treasurer and Tax Collector. The work of the Office of Financial Empowerment is to convene, innovate, and advocate to strengthen the economic security and mobility of all San Franciscans. My name is Andrea Yee, and I am the Financial Capability Program Manager for the Office of Financial Empowerment, and I lead our San Francisco Financial Counseling Program. San Francisco Financial Counseling, formerly known as Smart Money Coaching, provides free one-on-one financial counseling to anyone who lives, works, or receives any type of service in San Francisco. That's regardless of income bracket, regardless of immigration status. Yeah, we try to be as open and welcoming to as many folks as possible. San Francisco Financial Counseling Services are funded by multiple San Francisco city departments and are provided by our three service providers who have expertise in providing financial capability services to various communities in San Francisco. Balance is one of those service providers, and our two financial counselors joining us today are from Balance. Before I introduce them, just a couple of housekeeping items. This is going to be an interactive presentation, so feel free to share your responses and questions in the chat. This session is also being recorded, and we'll make sure to get the recording and slides out to you all who registered for this event after our webinar today. Without further ado, let me go ahead and introduce you to today's presenters. Chris is a certified financial counselor and educator with a background in financial services, accounting, and nonprofit work. He thoroughly enjoys problem solving with clients and celebrating their wins, both big and small. Julia is a University of California, Berkeley alum, go Bears, and she resides in the San Francisco Bay Area. Julia is bilingual in English and Mandarin, and we're excited to have her share her passion for helping others with our clients through San Francisco Financial Counseling. Chris, Julia, go ahead and take it away.
Well, thank you, Andrea, for this great introduction here. And yeah, just wanted to, we're obviously going to be talking about teens and money today. You know, the goal of this workshop is to prepare teens for financial independence by giving them, or you, if you are a teen in the audience here, on information on basic financial issues, including money management, preparing for future bills, checkings and savings account management, using credit wisely, and a little bit about investing. Before I jump into the presentation here, curious to see if we do have any teens in the audience today. And if you yourself are not a teen, feel free to share this presentation with the teens in your lives. Okay. Um, and for any participants that aren't in this presentation with us, I'm curious to see what brought you to the presentation. So in welcoming you, I'd like to, if you would be so kind to share with us in the chat there why you have decided to attend this workshop today and invest your time with us. Give you a few moments for that. And while that pulls up here, it's going to introduce, Andrea introduced myself and Julia, but I'm also going to introduce a little bit about Balance. You know, we are a nonprofit organization. We've been around providing financial coaching and education since 1969. You know, so it's over 50 plus years now, almost 55, 56 years. And 10 years ago in 2015, we did partner with the San Francisco Office of Financial Empowerment to embark upon what was then Smart Money Coaching. Now it's called San Francisco Financial Counseling, to provide free financial coaching and education, again, as Andrea indicated, to anyone who lives, works, or receives any type of services in San Francisco. In terms of our key areas of focus when it comes to personal finances, we do focus on credit, debt, savings, budgeting, and banking. And Julia, did you want to say hi to the audience?
Hello, everyone. I'm Julia. financial coach with Balance, and I'm very glad to see everyone here today. Let me know if you have any questions. I'll be monitoring the chat.
Excellent point. Yeah, Julia will be monitoring the chat. If you have any questions, feel free to pop them in there. We may address them in real time. We may save them towards the end. But anything that comes to mind, please feel free to let us know in the chat. All right, so again, today we'll be covering the basics of money management, how to save and prepare for typical future bills, why and how to use a checking and savings account, the wise use of credit, and the basics of investing. All right, so in terms of money management is a process of knowing where money is currently being spent and having a plan in place for where it should go in the future. It is important to know the difference between wants and needs in this case, which, knowing the difference will enable you to eliminate wasteful spending. Just to, if you, for those in the audience, if you can share with us what your kind of impression is, what the difference between wants and needs are. If you could give us an example, that would be great. We'll just wait a few minutes here. We don't seem to have a large audience. So if you do want to put that in the chat, great. If not, fine as well. And just one more thing on needs and wants. Wants make life fun, and they should be part of the budget, but not so much that you would have to sacrifice your goals or put your overall financial health in jeopardy. Just a little note on that. So in terms of setting goals, right, there is a big difference between dreams and goals. Goals are specific and measurable, while dreams are vague and almost like wishes, right? So, and when we discuss goals, we like to use a SMART framework: specific, measurable, achievable, realistic, and time bound. And for that time bound element, it's very helpful to differentiate between short, mid, and long term goals. Short terms are achievable in under a year. Midterm goals are achievable in the 1 to 5 year time frame, and anything beyond 5 years we consider to be long-term goals. So I'd like to take a moment to really think about what you want to do with your money, how much you will need for your goals, and when you want to achieve them by. And just want to ask anybody in the audience here if you would like to share one of your goals with us, specifically like something related to your money. If you want to save a certain amount by a certain time, that would be great if you could share that with us. Julia, do you have any goals you could share with for our exercise here?
One example is to buy a car in the next 2 years. So we can work backwards with the cost of the car to figure out how much to put aside every month.
Precisely, yeah. So let's just do easy math. Let's say you want to buy $10,000 car in 10 months. So real easy math, right? 1,000 a month to get to that goal. Now, so then, that information enables you to ask yourself, is that realistic for me? Do I have that amount of disposable income to save each month? And if not, okay, then you would simply adjust your goal. Find a lesser price car or extend the time frame if you want that same car. So thank you for sharing, Julia. That's a great example there. Another example, even just a savings goal, like you want to have 15,000 in 20 months. Julia, would you mind doing the math on that? So if you want to save 15,000 in 20 months, that would be a year and 8 months. So
that would be $750 per month.
$750 per month, right? So hope the point is coming across here. You have goals, but you can also be flexible towards your goals. We really encourage you to be flexible and realistic, and not be persistent and not give up. If you aren't able to meet your monthly savings goal, again, you can readjust. There's different strategies. And kind of on that note, I want to just promote our program here. We do provide financial counseling on a one-on-one basis. And if you are want help figuring out this sort of thing, our coaches would love to help you. at the end of the presentation, we'll give you the ways to schedule your own appointment for yourself or for people that you may know. All right, so now we'll talk about budgeting. Budget, all that is really a tool that will help you see how your money is being spent, and that will enable you to achieve your goals sooner. The most important rule of budgeting is that your expenses should never be more than your income. Many folks develop a budget with a simple piece of paper, but you can also use a computer spreadsheet or budgeting software. Some popular budgeting apps nowadays include Rocket Money, Empower, and Every Dollar. Julie, do you have any more other budgeting apps that you or your clients may be using?
Through Google Sheets, there are templates to make your own budget.
Yeah, Google Sheets, Excel. Again, you could use spreadsheets for budgeting. And some of those apps may have features that allow you to link your bank account or your credit card transaction history to the app, which will help you streamline the process of tracking and categorizing your expenses. All right. So in terms of income, on page 3 of the handout, which by the way is in the chat, the handout for this presentation is in the chat, and it will also be sent out by Andrea at the end of the presentation. On page 3, though, there is a monthly income chart, and for there's two major components to a budget, which are income and expenses. So as far as income, the key for income is let's see here, knowing your income sources and knowing your gross and net pay. So gross is before your wages, before taxes and deductions, and net is after taxes and deductions, what arrives in your bank account. That's gross and net. If you are a freelancer or work as a contractor or are in a contractor situation, your taxes are not automatically deducted, not automatically withheld for you. So it is important to set aside a portion of your pay to have that ready for when those taxes are due. And when estimating income, it is important not to overestimate. It is better to use conservative figures. So if you have for instance, if your salary may fluctuate due to the hours you may work, we advise you err on the side of the lower number and use a lower number, just so again, you don't overestimate. Okay, and now we'll talk about expenses, and this is what makes a budget a spending plan, is when we have a plan for your expenses. So this is where you can break down where your money is going each month. Many folks underestimate what they spend, which can lead to problems, right? Such as running out of money to pay those bills. So a spending plan can help you discover where you are spending your money now and decide how you will spend your money in the future. On page 3 of the chart, there's a bottom line section where you can find out if you're spending more or less than you make. So you'll be able to find out exactly that information. And seeing this all laid out in writing definitely makes it easier to change your income, expenses, or both, so you can come out ahead. So in terms of preparing for future bills, many young adults leaving home and living independently, that comes with a lot of expenses, and responsibilities. Moving out costs, can include everything from a moving van to first and last month's rent, various security deposits, furniture and appliances, all those things. Household bills often include cable, internet, garbage, gas, electric, water, all those utilities, all those sort of things here. And let's see here. Oops. And besides those housing costs, there's also other expenses such as cell phones or gym memberships that occur on a that reoccur every month. Those are ongoing expenses, you know. So oftentimes people do get into trouble with these expenses because they commonly require you to sign a contract, which can obligate you to make those payments for years. So we do encourage folks to think carefully about what you can afford by signing a contract and making sure that you understand those terms and conditions. So just want to also stress the importance of paying bills on time. If you do not pay on time, you could experience late fees, collection activity, and damage your credit, and perhaps suspend your rights to services. Okay. Now let's talk about buying a vehicle. You know, for many young adults, buying a car is one of the first major purchases that they make. It is critical that they first know how much owning a vehicle will cost and if their budget can handle it. You know, monthly payments, depending on whether the vehicle is new or used, economy or luxury, you know, gas or electric, so forth and so on. And the financing deal and down payment, the cost can vary significantly. Insurance. Liability insurance is required in most states, but it is a good idea to consider additional coverage, such as collision and uninsured motorist coverage. Maintenance and repairs is also a key factor with buying a vehicle. You know, even if you do have a warranty, you will still be responsible for routine maintenance. Once a warranty expires, the age and model of the car can make a big difference in how much you spend on repairs. So we encourage you to research how reliable, you know, potential cars are before you purchase. You know, in terms of gas, just getting from point A to point B can be expensive. You know, however, if you save money, you can save money by buying a car that has good fuel efficiency, or MPG, which is miles per gallon. You know, and depending on where you live and work, parking can also be a major cost. So we do encourage folks to save for a down payment and to borrow as little as possible, so you can get the lowest and buy borrow as little as possible at the lowest rate you can get, and to compare financing deals before deciding to go with one. You know, dealers can sometimes provide great financing deals on certain models, but you should avoid purchasing a car that is too expensive or that you do not really want, you know, just to get a specific deal. All right, now we're going to go into checking and savings accounts. You know, many banks and credit unions have teen accounts that are specifically set up for young adults, and they are a good place to get checking and savings accounts in general. You may also have the option, teens may also have the option of a custodial account, where an adult is the account owner until the teen turns 18, or a joint account, where the teen and an adult are both account owners. Regardless, everyone should have both a savings and checking account. Establishing a savings habit early is important, and a checking account will help you become independent and responsible. All right. So in terms of managing a checking account, you know, you should always know how much is in your checking account. Bounce checks can be avoided by using overdraft protection, keeping track of deposits, checks, ATM withdrawals, and fees, and never writing a check for more than you have in your account. Also, you should be able to check your account balances over the phone or online before you write a check. Although I know writing a check is kind of less common these days, but still people do write checks. And then when you do get your monthly statements, you should compare the record of transactions that you have with what is currently on your statement. This will allow you to see if you have made any errors in your record keeping, or if the financial institution has made any errors, and if perhaps that account is being used fraudulently. If you discover any errors or fraudulent activity on your statement, you should contact your financial institution immediately. All right. And when you open a checking account, you will be issued an ATM or a debit card. ATM cards can be used to withdraw cash, make deposits, transfer money between accounts, obtain your existing balance, etc., without having to go into the branch and speaking with the teller. Debit cards can be used at stores, restaurants, and ATM machines. They may look like credit cards, but they are not. Money is automatically deducted from a checking account when a purchase is made. So right now we want to definitely stress the importance of keeping cards safe and private. If cards are lost or stolen, or someone else uses them without permission, you should contact the financial institution immediately. All right. Now we'll talk about credit cards. Credit cards are, one way to think about them is they're like short-term loans. You make a purchase on your credit card and receive a bill for it in the next month, in that sense. However, we encourage you to see credit as just a way to build a positive history and not as a source of income. In other words, you should have the money to pay back what you charge when the bill comes, rather than leaving an existing balance on there. And it is best to pay off the balance in full, but if you're not able to, at very least you should make the minimum payment so you can avoid a delinquency and a late payment, as that can dramatically impact your credit score, which we will touch upon shortly. If you do become delinquent, you can be charged a late fee and be given a higher interest rate. So it is good to keep in mind that holding on to debt by not paying off the balance in full each month can be also very expensive. And the higher the interest rate, the longer it will take to repay that debt, the costlier it can become, which is covered also in the handout. This information is in the handout. So an example here that I'd like to share with you, like say, you're charged, when you go to college, or if you're in some trade school or what have you, you pay $500 for books and you charge them for your books and materials, but you can only afford to pay $25 per month on that, right? So if the APR, which is an annual percentage rate on that card, is 10%, it will take 1 year and 10 months to pay off that $500 debt. And there'll be $49 in interest in this example. However, if that interest rate, the APR, is 22% rather than 10%, for that same $500 charge, it will take 2 years and 2 months to repay, with additional $129 in interest. So that's almost a third of the original debt. So you see here how the interest rate come to play, paying the minimum payments come to play. So again, it's best if you can pay in full, but if not, at least make the minimum payment, but just be cautioned. Making that minimum payment can really be very costly, especially when you factor in that interest rate. All right, so how you treat your credit cards and other type of credit, such as loans, that sort of thing, really do matter. And your credit history basically, follows you for a long time. Especially in America. Internationally, credit scores kind of differ from country to country, but in the United States, the credit history is very impactful. So the information that actually shows up on an actual credit report, which you can get for free, and we'll give you that information, how to access that later, is right here. So the date the account is open really speaks to how long the accounts have been open. And if payments were made late, the report will let you know how often, or if they have been made late, and how late those payments are. If you have any accounts with collection agencies, how much you currently owe to your creditors, and what your credit limits are, both for individual credit cards and for your overall credit cards. Also, what's revealed on a credit report is if you've been sued to collect on a debt, as well as any other legal information, and also if you had filed bankruptcy. So everyone has a right in the law to see your credit reports, and we recommend that you view your credit reports at least annually, if not twice a year, for accuracy. And the handout on page 7 will guide you to how you can access that information for free. But Julia, if you do want to put annual credit report in the chat, that would be great. That's again a free way you can, a free resource for you to access credit reports through all 3 of the credit bureaus, which you see right here. Equifax, Experian, and TransUnion are the 3 credit bureaus. All right, now in terms of credit score, so there's 2 kind of prominent scoring models out there, which are FICO and Vantage Score. So I just want to differentiate for you in your minds. There is the credit report and a credit score. Those are 2 different things. The credit scores come from the information that is gleaned from the credit report. Okay, and the range goes from a low of 300 to a high of 850 in both scoring models. Both FICO and Vantage Score go from 300 to 850. And, as you see here, having a good credit score is important for many, many things. So for instance, buying a vehicle, the most attractive interest rates are available to folks with high scores. Getting a cell phone. Companies may deny service or a contract if there's evidence of a poor payment history. Renting an apartment, landlords look at credit reports to assess financial responsibility and debt load. One area that we do help a lot of folks with is, finding affordable housing, finding housing. And, this is the main area of our focus really is that area of credit, in addressing any issues with credit. Julie, if you can maybe put in the link to schedule an appointment for folks. Again, I just want to take a moment to promote our free services for people who live or work in the city or receive services in the city. We help folks, again, with this key area of credit. All right. Qualifying for low insurance rates. Studies have found that those with lower credit scores tend to file more claims, which ends up costing insurance companies more money. So basically, those with higher credit scores often get lower rates because they represent a lower risk to those insurance companies. And finally, buying a home. Mortgage lenders rely on credit scores to determine the interest rate that the applicant is eligible for. And because these loans are often very large, having a low score can cost you thousands of dollars per year. And if your scores are very low, you may not even qualify to get a mortgage. All right, now let's talk about card types. So unsecured credit cards are basically regular credit cards. Whether or not you can get an unsecured card and the interest rate and credit limit you are given if you are approved is dependent on your credit score, which makes sense. A secured credit cards basically require you to put down a deposit, which the lender gets to keep if you are unable to make your payments. Secured cards are easier to get than unsecured cards. Reason being is that they represent lower risk for the lender. So those can be, a secured card can be an attractive option for those with poor or non-existent credit history. And we often recommend this to folks, for such a situation. Charge cards are issued based on credit history, but have higher limits and annual fees than many credit cards. Charge cards require that you pay off your balance in full each month, however, unlike credit cards. And you cannot carry a balance again, unlike a credit card. So those are the difference there between a charge and credit card. Store and gas cards can only be used at those places where the cards are issued from, right? So if it's from Chevron, it's only used at Chevron stations. It's like a Nordstrom card, can only be used at Nordstrom, so forth and so on. Debit cards are not credit cards. since the money is withdrawn from your checking account immediately whenever you make a charge. So there's no credit component to debit cards. It's withdrawn immediately from your checking balance. So teen and prepaid cards are like debit cards. So basically in those situations, the account is loaded with money that can be used anywhere that debit cards are accepted. So it's a good way for teens to kind of get into the habit of using the debit cards and spending wisely, making sure they're within their spending limits. All right, now let's talk about what do you look for in a credit card. Not all credit cards are created equal. So when deciding what card you should get, you should look for the following features. So I spoke on this term earlier, which is a low APR, right? An APR is the interest rate you are charged on your balance when you do not pay the balance off in full each month. Basically, the lower your APR, the less money your debt will cost you. However, if you never carry a balance, the APR won't even matter at all. So again, that's why we advocate paying the card in full if you can each month. So you won't be charged any extra money for whatever purchases that you do make. A grace period is how long you have to pay off the balance before you charge interest on any new purchases. So we advise you go with a card that does give you a grace period, although be aware that it only applies if you pay off the balance in full from the previous month. Low cash advance fees. With a cash advance, you are given cash. But even if the fees are low, it is usually best to avoid cash advances. In addition to paying a service fee for those cash advances, there's typically no grace period for those cash advances. So right away, you're charged at APR. And those APRs for cash advances, if you look at the fine print of your credit accounts, it's usually higher than your normal interest rate for purchases. So really highly recommend you do not use your credit cards for cash advances because it can be very, very costly. We also advise that you look for no annual fee. If you have a good credit score, you should be able to get a card without an annual fee. But if you are new to credit, you may find it hard to get a card that does not charge one. However, after a year or two of on-time payments, you may be able to have that fee eliminated altogether. And finally, we advocate that you look for low penalty fees. You may be charged a fee if you pay late, if you pay after the due date or go over your credit limit. So really though, we highly advocate you avoid those altogether by managing your account and your budget and your cash flow so that never occurs and you never incur those late penalties. But if you want to make sure that those late penalty fees are low just in case. Sorry, Julie, I want to pause here. Do you have anything that you wanted to add to anything I've discussed so far?
I don't see any questions so far.
Okay, sounds good. All right. With credit cards, there are also many different types of users. What type of user you are determines whether or not you are responsible for making those payments. So an authorized user, if you are an authorized user, you are able to use the credit card, but you are not responsible for making payments. The primary user is responsible for making payments on the card. For a cosigner, if you are a cosigner, both you and the account holder, or the other account holder rather, are responsible for making payments. This does not mean that you cannot designate one of you to make the payments. All that means is that if the payment is not made, the creditor can legally come after either of you for the money. So that applies to the cosigner situation. Individual user, basically that's pretty straightforward, as the name implies. The individual account holder is the only one that can use the account and is the one responsible for making payments on that account. If folks are under 18, they're only permitted to be an authorized user on a credit card. So they can't be an individual user or cosigner on a credit card. If folks are under 21, they will need a cosigner or verifiable income to get a credit card. So those are the types of credit users. Now we'll discuss the importance of using credit wisely. If teens do all of these items, they will not get into the same financial trouble that many adults do experience. So really advocate you never charge more than can be repaid by the bill's due date. If you cannot afford to pay the bill, the entire bill, at least pay more than the minimum required payment to avoid stretching the debt out for a long time and paying a lot in those finance charges. Paying on time to establish a good payment history and avoid fees. Limit the number of open cards, and keep cards private and safe by never sharing cards or leaving statements or account information out where someone else may see it. All right. So now we'll just touch about, some investing basics. Investing money allows it to work hard for you instead of you working hard for your money. In terms of the types of investments, you can buy and sell stocks and other investments through a brokerage firm. Online and discount brokers are the least expensive way to invest, but they offer no or little advice, right? Full service firms do offer advice, but they can often charge a higher commission. For those under 18, you may need to have a custodial account or have your parents buy for you. All right. So in terms of investment types, before you consider buying any security, you should know what they are and how they work. Stocks are shares of, they represent shares of ownership, a percentage share of ownership in a corporation. While long-term stocks tend to provide the highest return over time, there's a lot of fluctuations in stocks in terms of the value. So one day the stock might be worth more, the next day, could be much less. A lot of volatility in stocks. A bond is a loan to a company or a government. Generally, the bondholder receives the principal called the par value, at the maturity of the bond, at the end of, so that's basically when the bond is at the end of the bond period, that's when it matures, which could be in a few months or several years, depending on the terms of the bond, and interest, which is called the coupon rate. And so periodically, usually twice a year, interest is paid out while you're holding the bond. There are investment grade bonds, which are low risk and low coupon, and junk bonds, high risk and high coupon. Cash equivalents, consist of assets that can be readily converted to cash. With cash equivalents, the risk of losing your money is low, but so is the return on your money. The return may be so low that it can be less than the rate of inflation, right? So that's something to consider. However, since cash equivalents are safer than other investment types, it is a good idea to keep some of your savings here. We personally recommend for our clients, emergency fund are held in as cash equivalents. So emergency fund is about 3 months, maybe 6 months of your essential expenses. Just so in the event of some sort of like emergency, like your car breaks down or you lose your job or what have you, you're able to sustain yourself with your basics for a few months, rather than turning to credit, which can compound the problem because you're going to be applying interest to large sums of money. So in terms of cash equivalents, some examples here are checking and savings accounts. With checking, with those accounts, you deposit the money with financial institution and you receive a little bit of interest in return. You can withdraw your money at any time. And the good thing about those accounts with banks is that those accounts are insured by the FDIC, meaning that you will be able to access your money if the financial institution goes out of business even. So it's insured, those accounts are insured up to $250,000. Another cash equivalent is certificates of deposit or CDs. Excuse me. With CDs, you also deposit your money with a financial institution, but you're required to leave it there for the term of the CD. CDs are insured and generally have higher interest rates than savings and checking accounts. Money market deposit accounts are similar to savings accounts, but the interest rate is usually higher. They are also insured and may come with limited check writing privileges. Money market mutual funds are mutual funds that invest in short-term debt obligations. While generally considered to be safe, money market mutual funds are not insured and provide no guarantee against loss. And finally, we have U.S. Treasury bills, which are short-term debt obligations to the U.S. government. And mutual funds. Mutual funds combines the money of different investors to purchase different stocks, bonds, and/or cash equivalents. And because each fund is made up of a wide variety of investments, they're already diversified, which is important for spreading risk. So being young is an asset when it comes to investing. There's a lot of time to save, time to recover from mistakes, and rebound from the rise and fall of the stock market. So starting early allows you also to really take advantage of compound interest, which is earning interest on interest. When compound interest is put to work for the longest amount of time, investors can make a really good amount of money, even with modest deposits, making minimal contributions. So we really encourage folks to start early. Make regular contributions, early and often, and not take out that money until you've reached your financial goal. And really want to also explain harnessing the power of time. This example you see here assumes a $2,000 per year investment. So the investor is investing, they're depositing $20,000 per year. And the average rate of return here is 9%. So as you see here, over 30 years, that same yearly investment of $2,000 at a 9% rate of return would become $272,615 over 30 years. But if that same investor were to wait 10 years, so if you look at the example here of the 20-year time frame, that same pattern of investing, so $2,000 per year at a rate of 9% per year, they're barely making $100,000. So again, this is kind of speaking to the power of time and letting the compounding work for you. So, if you start with a little bit and you start early and you let the power of compounding interest work for you over time, can really grow your wealth tremendously. All right. So basically, in summary, really encourage teens and young folks to learn about as much as you can about money now, early enough, and get yourself, in whatever way you can, whether it's friends or family. There's a lot of great resources on social media, on YouTube or so forth, where you can, books, of course, many books. And again, we do partner with the San Francisco Public Library, so they have abundant financial literacy resources that you can partake of, including, of course, our service of San Francisco Financial Counseling. Really do some research and learn as much about money as much as you possibly can, now and throughout your life, and we want to assure you that everyone does make mistakes. But errors are best if you make them on a small scale, and you should certainly learn from them. And finally, we want to stress the importance of enjoying your money. It's not just for your future security, which we want to definitely start planning for, but also to improve your standard of living today. And let's see here. yeah, once again, want to thank the attendees here for attending, and kind of stop for a moment to ask if there are any questions from the participants. And if you do have questions, please pop them in the chat. And just to kind of recap here, Balance is a financial and education counseling services organization. Our services include money management, debt repayment options, credit report review, identity theft solutions, housing education, student loan education and guidance and counseling, and many more. All right, here. So here are the steps to connect with a financial coach. And again, these slides will be provided to you by Andrea. So there's the website here. You can schedule an appointment. You can also call this toll-free number or email this email address if you want to schedule an appointment. And yeah, Julie, do you want to kind of speak to our coaching experience or processes? Want to shed some light on that?
We are at the library, and we also hold phone appointments and video appointments throughout the week. So whichever modality works for you, we can schedule an appointment that way.
Absolutely. Fantastic. That's a key point. Yeah, we do offer in-person and virtual or on the phone counseling. If we need to share screens, we use Microsoft Teams to if folks like want to have a have a visual aspect, or again just like share screens if we need to do that. And yeah, want to thank SFPL and Andrea, if you want to jump in here.
Thanks, Chris. Thank you both for that great presentation, and thank you all for joining us today. We hope to see you sign up for a San Francisco financial counseling session, and we also hope to see you at our next webinar that will be Get Your Money Right with the SF LGBT Center on August 13th from 1 to 2 p.m. I'll go ahead and share that flyer along with the slides and recording from today's presentation. And when I email that to all the folks who registered. Thanks so much, and enjoy the rest of your day. Take care, everyone.